Good evening, everyone, and welcome to another technical look at the precious metals market. My name is JR. Today is Monday, September 22nd, after hours, 7:22 p.m. Eastern Standard Time. I actually did a video on Friday, but video turned out to be 28 minutes long, a little bit too long for my taste, but I had a lot of information on there. I've been asked how I get my support zones and my resistance zones. So I talked a little bit about that, but I think I'd rather just do this over and try to make it as fast as possible. Here, let's actually start with the gold chart. Okay, so basically this is the way it works. When we look at a chart, let's say this is a weekly chart here. So we look at a market, let's say this is obviously an uptrend, right? So what I look for in order to pick these zones, these buying zones and these selling zones, is very simple. I look at where the people are buying, where the big institutions are buying. And based off that, we make our decisions on whether we want to go in or whether we want to come out, right? So perfect example here, let's say this right here. Now, normally people would look at this line and they would see an uptrend, right? I don't necessarily look for that uptrend. Obviously I do, but I don't necessarily see a line where every time we hit the line, we buy. That's not necessarily what I do. What I do is I look for places where the market trades sideways and look for a reaction. Because remember that the market doesn't move on buyings and sells. The market moves on orders. Big institutions can't buy tremendous amounts of anything in one shot. They have to spread their orders evenly, right? So let's say over here, for example, you had a sideways consolidation. You have up and a drop. Side, drop, rally, right? So we had base, drop, base, drop, base, rally, base, rally. And that's what I look for, right? So this would be a zone here, right? And why do I say this is a zone? Because this is a drop, this is a base, and then a rally. So this is a buy zone. As you can see, okay, when I'll zoom this up a bit, I'll zoom it in a little bit. The market rallied, came back down, touched the zone, and it took off, right? So we had a rally, a base here, a rally, base, rally. And that's basically the way it works. So what you want to do is you want to look for the bases and you want to look for the rallies, because again, these zones represent where the big institutions are. Because if the market ran up fairly quickly, that means that it picked up a lot of orders. And you would assume that because you had that rally, there were a lot of orders in that area. And when that area is touched again, more orders are going to get executed. The more you touch a zone, the more orders get executed. If there's not enough orders, the rally won't be significant and it'll break that significant zone. And so that's basically it. So if we look at this monthly chart here on gold, right, this is what I'm looking for. I'm looking for a rally here, right? So I'm looking for a rally here. The rally started here, and what can we see? We can clearly see that we had a rally, a base, drop, drop, base, a small rally, and another base, and then what happened? You had a market take off. So there were so many orders here that this market just shot up. We had a little bit of a base here, and then a significant rise, right? So basically, the way it worked is this is your buying zone. This is where all the orders are. Not all the orders are able to be. Not all the orders were executed. So you assume that when the market comes back down to this zone, you're going to have all of those orders continue to get executed, and you're going to see another rally. And that's basically how I get these zones, right? So you had a rally. You had a base up here, and then you had a drop. And the second it touched this zone again, you had the rally. Now, again, you had some sideways consolidation or a base. You had a rally, sideways, rally, sideways, rally, sideways, rally, sideways, and etc. So we can clearly see here that This was a rally right here. You had a really nice engulfing candle here, and the second to touch this line here, you had a big move to the upside. Now, normally, this I would draw this somewhere like this. But once you have a penetration, so once you had this penetration and it came in under this, then what we can do now is we can redraw that line because you penetrated this level here, and now you put it at the bottom of the test. Okay, so again, you had another sideways consolidation here, which we can also see here that I would probably say somewhere around here because you had that bullish engulfing candle, right? And this is where it would end right here, right? So this is where your base is. This is where the rally is. You see how it took off here. And as you can see, it actually came into this zone and it came right back up. So it came into the zone and it ended up closing here. That's when we had this big drop. Now, normally, when this line breaks, you don't necessarily want to buy here. You want to wait to see what this market is going to do. So based on that, you had a drop. You had a big penetration of the zone here. So automatically, what you want to do is you want to delete this zone here. You want to make this level like this because this level was touched. So as you can see, it touched it once, it touched it twice, and finally the third time was when it broke. But every time you bought here, you were actually able to make some money. But again, I wouldn't have taken this trade simply because this significant trend line was broken. So you don't necessarily want to take that. So that's your monthly chart here, right? So let's look at the current situation here. Now on this monthly chart, we can clearly see that this zone here has been tested 2 times already. It looks like this zone will be tested again. The more we test the zone, the more orders will get absorbed. The more orders get absorbed and the less we rally. That basically means that there's not enough orders. There's not enough orders to make this market rally. So we can easily see here that when this zone, if this zone is taken out, and again, it does look like this zone will be tested roughly here on the 1180 zone. The more you test it, the more likely it is to take it out because again, you are absorbing all those orders that are left. And this will be your next zone here, okay, 1117. And this is based on the monthly chart here for gold. On the daily chart, on the weekly chart, you probably have different zones. So between 1159 and 1180, there's a lot of orders there. So what we want to see if there's going to be enough orders to take this market back up, right? That's your monthly. Let's look at the weekly. Okay, weekly, very similar. So again, on the weekly chart, your next zone would be roughly 1110. I think on the monthly, it was 1117, right? So this is where we're going to have all of those orders. How do we know? Because there were so many orders back here that it just took off. The market just took off. So we can clearly, we can easily see that this zone here would be the next significant level. So between 1042 on this weekly zone all the way up to 1114 will be the next zone if this 1150 to 1180 zone is taken out. This will be your next level. Now, again, if this level is taken out, then very simple, the next zone will be roughly right. You have a zone here, but this nested within this zone, so we're going to skip that zone. And this will be your next level. Okay, between 980 and 1000. Is the market going to go that low? If I was just looking at the technicals, I would probably say that this zone would be taken out. Then this will be your next level. It's hard to say because production cost for gold is 1200 plus. So anytime you fall below production cost, it is said that anytime you buy anything below production cost, you're almost practically guaranteed to make money. So at this point, it's really just a matter of how low can these manipulators bring these prices down. So if this market is being manipulated, but one thing we do have to take in consideration is that the reason why we're printing money and the reason why interest rates are at zero, it's so we have a weak dollar. That's not happening. So what's going to end up happening is if we continue to see low inflation and prices continuing to decline and a strong dollar, we're going to see more efforts by the hands by the powers that be in order to get this dollar to weaken, because obviously that is going to kill our exports, right? So that's on the weekly chart. So the next zone, if this level is taken out between 1150 and 1180, then your next zone is this one. I can't imagine this would go much further down than this level here. But again, I never anticipated this market to go down below the $1,500 range anyway. But that's up to us to see, right? So that's the weekly zone. I'm just going to do a long-term analysis on both gold and silver. So on silver, okay, same thing, okay? This is a significant zone here for silver. Why? Because this is the level where we accumulated there was so much accumulation going on here that look what this market did. So again, this market hitting this level here of 1815, it's a significant level simply because there were so many orders back then. But we can also see that the market on Sunday evening, this is the low of the range. So we can see that this is where the market took off. This would be the bottom of the range here, 1734. And we can see over here that on Sunday night, the market touched exactly the bottom of the zone, which was right here. Okay, 1732. So 1732 was the exact bottom of that zone, and we can clearly see that we did find support at that bottom of the zone. Now, normally I love to buy at the bottom of any zone because now your risk to reward are phenomenal. So for example, if you're buying at 1732, you put a stop loss at 1710, 1715, you have a 15-cent risk, and your reward is the market is already back to 1773. So the risk to rewards are great, but again, when you break such a significant level like we did on Friday, I wouldn't dare to buy here even at the bottom of the zone. It doesn't matter. We want to see where the market is going to do. Now we have another zone here between $17 and $16.50. And which has not been tested yet, but before we test that level, we have to break this zone here, which is the 1730 to the 1812 zone. Okay, so that's the zone that we have to break before we go to the next zone, which is this one. Like I said, $17 and between $16.50 and $17. Now I've already made all my purchases here in this area, and I really like these prices. At this point, it's really just a matter of allowing this market to do what it's going to do. I can't imagine that the dollar is just going to continue to strengthen and have the Federal Reserve just stand there and do nothing about it. So the more the dollar rallies, the better it is for the metals, because at the end, that's not what their goal is. Their goal is to have a weak dollar, and the U.S. dollar is gaining strength against all major currencies. So it's just a matter of time before the Federal Reserve decides that they're either going to keep interest rates, decides that they're going to keep interest rates really low for a longer period of time than we anticipate, which is usually the case, or they're going to decide they're going to print more money. I would say that as of right now, short-term positions, yeah, that's fine, because we can continue to trade on the shorter-term time frames. And so that's not a big deal. But long-term positions, I would probably say that the next time you want to buy any more long-term positions is probably between the 1470 range to the 1550 range, this level here. Not that we're going to see that level. I'm not suggesting that. Again, the production cost for silver is usually $18 to $22. Right now, you're at $17.70. So just like gold, you're below production cost. So again, like I said, anytime you buy below production cost, you're, as they say, you're almost guaranteed to make money, simply because those prices will not be able to sustain themselves. Now, a technical analyst, anyone who reads charts can clearly see that these are important zones, and if we break below this 1820 zone, we can technically come down here to the $15 zone. But again, gold and silver are not your average. It's not your average market. Your average market doesn't take off the way this did, simply because of political tensions and monetary policies and so on. So that's your silver chart. So again, on the silver chart actually, very impressed with the fact that silver didn't we didn't see a follow through on silver. We have to see what's going to happen tomorrow and have to see what's going to happen in the next couple of days. But we did not see a big follow through, which is expected after you break significant level at 1820. You can clearly see that this is a very, very significant level here. Okay, and we can see here that every time we touch this zone here, we saw a big bounce. But what obviously happened is all these buyers got absorbed. So now we have to wait for the next zone and see if there's going to be enough buyers to bring it back up. Now, again, we have a big wick here, which is fairly positive. But at the end of the day, we still need to see how this market is going to play out in the next couple of days. Because again, there's only two ways that this is going to go. This is going to end. I see. This is either going to come down here and test this long-term trend line over here, roughly around the 1680, which is a confluence. Okay, which is a confluence with this zone here. That's why I put this circle here, because this zone used to be resistance and now is this support. Now it is support. So when you have these prices come down over here, okay, at around 1688, great time to accumulate if you don't have 10-15% of your monies and precious metals, especially during these chaotic times with the Dow Jones is at 17,200 plus. You have to wonder, when are you going to start buying these metals at a discount? Now, if you've already accumulated 8, 7, 10%, I wouldn't accumulate anymore. I would probably wait for a lower price, maybe $15, because if it takes off from here, you already own it anyway. But if you don't have 8 to 10% of your net worth and of your investment assets, of your investment funds in here, then in this zone, this is where you definitely want to continue to accumulate. Add an extra 2%, add an extra percent, because at the end of the day, we all know how this is going to end. Wars, bad monetary policy, printing money, interest rates at almost zero, and competing currencies to decline. So again, we understand what these fundamentals are going to add up. Unfortunately, they just haven't played out just yet. But again, I'm confident. I personally think that the dollar is going to continue on its 100-year path, which is continue to decline and decline. I have some articles here also that I want to show, but that's going to be on the next video. That's going to be on a research video. There's a few articles that I want to share with everyone. And again, I'm looking at these prices as a discount. So again, continue to accumulate. This is where the shake-off happens. People get shaken out of the market, and next thing you know, the second you sell your positions, then you have a huge rally. So again, that's your gold and that's your silver chart. Stay tuned for the next video. That's going to be a research video. I'll have that out. If I don't have it out tonight, I'll have it out for you guys first thing tomorrow. All right. Enjoy the rest of your night, and thanks for joining me. Bye-bye.